Disclaimer: Japan's 30-year government bond yield has just surged to the highest level since these bonds were ever created. And in response, the US Federal Reserve has stepped in to stabilize the yen. Think about what that actually means. The United States is now actively supporting the currency of another country. If this becomes the new normal, sustained dollar weakness is no longer a theory. It's a structural risk. This isn't something that might happen anymore. It's already happening. And if you don't understand why, your money is exposed. For decades, Japan has played a very specific role in the global financial system, not as a growth engine, not as a market leader, but as the cheapest source of money on the planet. Japan's economy stagnated for years, its population aged, and growth remained weak. But that weakness created an opportunity the rest of the world quietly exploited. Interest rates in Japan were pushed down to near zero and held there for so long that borrowing yen became almost free. Global investors, hedge funds, banks, and institutions took advantage of this by borrowing in yen and investing that money elsewhere. This became known as the carry trade: borrow cheap, invest where returns are higher, collect the difference. That difference funded everything: US government debt, corporate bonds, tech stocks, real estate, private equity, even speculative assets. Over time, the carry trade stopped being a trade and became part of the system itself. It grew so large that markets began to assume it would always be there. But this system has one critical weakness. It only works if Japanese interest rates stay low. The moment Japanese yields rise, everything starts to break. Borrowing costs jump, currency hedges become expensive, profits vanish, and investors who were never planning to exit are suddenly forced to unwind positions they cannot afford to hold. That's exactly what's happening now. Japan's long-term bond yields aren't just rising, they're breaking decades-long ceilings. The 30-year yield hitting an all-time high is not a minor data point. It signals that the market no longer believes Japan can suppress rates indefinitely. And once that belief cracks, the consequences move fast. This is not panic-driven selling, it's mechanical, algorithmic, mandatory. Funds are required to reduce exposure as risk thresholds are breached. Leverage has to come down, positions have to be closed, assets have to be sold, regardless of price. And when those assets are sold, they're not sold in Japan, they're sold everywhere else. US treasuries are often the first to go, they're liquid, they're large, and they're widely held. And when Japanese investors bring money home or global funds unwind yen-funded trades, treasuries get dumped. Yields rise, bond prices fall, and suddenly, what was supposed to be the safest asset in the world becomes a source of instability. That's where the pressure starts feeding back into the system. Higher treasury yields don't just affect bond investors, they reprice everything. Mortgage rates move higher, equity valuations compress, growth stocks that depend on cheap capital lose their appeal, pension funds face funding gaps. Banks see unrealized losses expand on their balance sheets. This is how a bond market issue quietly becomes a financial system issue. Now add another layer. As Japanese yields rise and capital flows reverse, the yen strengthens rapidly. On the surface, that sounds positive for Japan. But in reality, a sharp yen move is dangerous. It accelerates losses on carry trades and forces even more liquidation. The stronger the yen gets, the faster assets elsewhere must be sold to cover positions. This feedback loop is what the Federal Reserve is trying to interrupt. The Fed isn't intervening because it wants a strong yen. It's intervening because a disorderly yen move threatens US financial stability. A violent unwind would push Treasury yields higher at a time when the US government is already struggling to finance massive deficits. That's the part rarely discussed. The United States is issuing debt at a historic pace. It depends on constant, reliable demand for treasuries. Rising yields increase borrowing costs instantly. Every percentage point higher translates into hundreds of billions in additional interest expense over time. That money has to come from somewhere. So when yields rise too fast, it becomes a policy problem, not just a market outcome. This is why you're seeing coordination rather than denial. Central banks understand how fragile the plumbing has become. The global system is interconnected through funding markets, currency swaps, and bond flows that most people never see. And when those pipes start rattling, authorities respond before the public notices. That doesn't mean the risk is gone. It means it's being managed temporarily. The problem is that managing symptoms doesn't fix the underlying issue. Japan cannot raise rates without destabilizing its debt market. The US cannot tolerate much higher yields without destabilizing its own finances. And global markets cannot function without cheap liquidity forever. These realities are now colliding. For years, markets were trained to believe that central banks could always step in and smooth things over. Lower rates, more liquidity, emergency facilities. That belief created complacency. Risk was mispriced because downside was assumed to be limited. But what happens when intervention itself becomes the signal of stress? When the Fed supports a foreign currency, it's no longer acting from a position of strength. It's reacting to pressure, and markets sense that shift immediately. That's why volatility isn't spiking randomly. It's clustering. It's appearing across asset classes at the same time. Bonds, currencies, and equities are all moving in ways that suggest underlying tension. And this tension doesn't resolve overnight. Carry trade unwinds don't reverse cleanly. Once leverage comes off, it doesn't rush back in. Trust has to be rebuilt. Risk limits are tightened. Capital becomes cautious. Liquidity thins out. That environment feels very different from what investors have grown used to over the last decade. It's quieter, less explosive, but more dangerous. Instead of sudden crashes, you get persistent pressure. Rallies fade, drawdowns last longer. Safe havens don't behave the way they used to, and diversification stops working the way people expect. This is how wealth erodes slowly, not through a single dramatic event, but through a series of adjustments. Most people won't recognize this shift until it shows up in their long-term holdings. Retirement accounts underperform. Bond funds fail to protect during equity sell-offs. Cash loses purchasing power as currencies weaken simultaneously. And because nothing breaks all at once, the urgency gets ignored. But make no mistake, when global funding structures start unwinding, they don't do so politely. They unwind until leverage is gone, assumptions are reset, and prices reflect reality instead of convenience. That process is underway. The reason this matters now is not because of one bond yield or one intervention. It's because the system is revealing where the pressure points are. Japan, US debt, currency stability, global liquidity. Once those become unstable at the same time, the margin for error disappears. This isn't about fear or prediction. It's about recognizing when the rules are changing, when strategies that worked for decades stop working quietly, when safety becomes relative instead of absolute. And in moments like this, the biggest risk isn't volatility. It's misunderstanding what's actually happening while assuming everything will eventually go back to normal. Because sometimes normal doesn't come back the same way. Once the unwind begins, it doesn't move in straight lines. It spreads through layers of the financial system that most investors never think about. Funding markets tighten first, then liquidity thins. Then correlations that used to protect portfolios suddenly move in the same direction. This is where people get caught off guard. Most investors are trained to watch stock prices, but stock prices are downstream. The real stress shows up earlier in bond auctions that fail to clear smoothly, in currency swap lines that get quietly expanded, and in volatility spikes that appear without a headline trigger. When Japanese yields rise and the carry trade reverses, capital doesn't just disappear, it moves. And where it moves from and to determines who feels pain first. US Treasuries sit at the center of this process. For years, they were treated as the ultimate safe asset. But safety depends on demand, and demand depends on confidence and liquidity. When leveraged players are forced to sell, Treasuries become a source of cash, not protection. As yields climb, the impact compounds. Bond prices fall. Losses appear on balance sheets. Banks and institutions that were already stretched by previous rate hikes see capital ratios tighten. Lending standards harden. Credit becomes selective. This is how stress migrates from markets into the real economy. Mortgage rates respond almost immediately. Housing activity slows. Refinancing disappears. Commercial real estate, already under pressure, feels another wave of strain as borrowing costs remain elevated. Developers pause projects. Valuations reset lower. At the same time, equity markets struggle to find footing, not because earnings vanish overnight, but because the discount rate changes. Future growth becomes less valuable when capital is expensive. Stocks that thrived in a low-rate environment lose their premium. Volatility becomes persistent instead of episodic. This is not a crash dynamic, it's an erosion dynamic. Rallies become shorter, sell-offs become deeper. Investors who bought every dip over the last decade discover that liquidity no longer rushes in the same way. Central banks still intervene, but their tools are less effective when inflation, debt, and currency stability are all constraints at once. And this is where the dollar enters the equation in a more uncomfortable way. For years, global stress meant dollar strength. Capital fled to the dollar as the world's reserve currency. But when stress originates inside the U.S. bond market itself, that relationship changes. Supporting the yen signals that authorities are willing to weaken the dollar to prevent larger systemic damage. That's a subtle but profound shift. A weaker dollar doesn't immediately feel like a crisis. It shows up gradually. Import prices rise. Purchasing power erodes. Commodities behave differently. Inflation becomes harder to suppress without causing financial damage elsewhere. At the same time, foreign demand for U.S. assets becomes more selective. Investors demand higher yields as compensation for currency risk. That pushes borrowing costs higher still. The feedback loop tightens. This is why policymakers are walking such a narrow line. They need to prevent disorderly market moves without signaling loss of control. They need to stabilize funding markets without reigniting inflation. They need to maintain confidence without pretending nothing is wrong. And markets are testing that balance every day. What makes this environment especially dangerous is that traditional diversification stops behaving the way people expect. Stocks and bonds fall together, currency hedges become costly, volatility protection becomes expensive just when it's needed most. Investors who relied on models built during decades of falling rates are suddenly operating in unfamiliar territory. This doesn't mean everything collapses. It means everything reprices. Capital becomes cautious. Leverage stays lower. Risk premiums rise. Returns become harder to earn and easier to lose. That shift alone changes behavior across the system. Companies delay buybacks. Mergers slow. Venture funding tightens. Speculation fades. These are not dramatic events, but they reshape markets quietly and persistently. And while headlines focus on daily moves, the more important story is what's happening underneath. Balance sheets adjusting, assumptions being questioned, liquidity being rationed instead of abundant. This is what a transition period looks like. It's uncomfortable because there's no single moment where everyone agrees something has changed. Instead, confidence erodes in stages. Each intervention buys time, but also signals fragility. Each rebound restores hope, but fails to restore the old structure. And the longer this lasts, the more it reshapes expectations. Investors begin to demand real compensation for risk again. Safe assets are scrutinized instead of assumed. Currency stability becomes a variable instead of a constant. These shifts don't reverse quickly. They become the new operating environment. That's why understanding this moment matters so much. Not to predict the next headline move, but to recognize the direction of pressure. To understand why markets feel different. Why reactions are sharper. Why recoveries feel weaker. This is how long cycles turn. Not with a single collapse, but with a slow recognition that the tools, assumptions, and shortcuts of the past no longer work the same way. Those who adjust early focus less on chasing returns and more on preserving flexibility. Liquidity regains value. Balance sheets matter again. Exposure is questioned instead of maximized. Those who don't adjust keep waiting for conditions to go back to normal, even as normal quietly moves on without them. And that's the real risk in moments like this. Not volatility, not uncertainty, but complacency. Because when systems built on cheap money begin to unwind, the danger isn't that everything breaks at once. It is that things weaken just enough, just long enough to catch people unprepared. This is one of those moments. If this breakdown helped you understand what's actually happening beneath the headlines, make sure to like the video and subscribe to the channel Economic Records.